The situation in Japan has fascinated me for a long time. Starting, I believe, around 1990, there was a total reversal in how you looked at Japan as an investment. Up until that point, after World War II, Japan has, I think, one of the greatest records of growth. The country was growing at a strong rate, in part because I think initially when the Korean War started, why Japan being across the straits from Korea could be a source for the U.S. Army, for MacArthur, to get various supplies and so on, and that was one of the factors that started the growth phase of Japan, which lasted right through to the end of the 1980s. And then, for a variety of reasons, that growth phase changed, and the growth rate started to slow down dramatically. At the same time, the country was trying to do their best for their citizens, and one of the things that started happening was that the budget started to go into heavy deficits. And initially, that deficit was relatively small compared to the overall size of the GDP. But in the last few years, the deficit as a size of the GDP in Japan, I believe, is about the highest in the world, at well over 2 to 2.5 times the GDP. And yet at the same time, the interest rates were kept very low because there was no or little inflation. As a matter of fact, for some period of time, there was deflation of the currency, of the yen. As of 2 or 3 years ago, this began to be very intriguing to us at the Occasional Speculator as a potential way to make money by shorting the 10-year Japanese bond, which at that time was being bought by Japanese citizens, even though the interest rate was less than 1%, maybe less than 0.5%. And things started to change so that the ability to keep that interest rate that low, I start to feel, was weakening. And because the size of the debt was so large, that it became increasingly possible to see, hey, they're going to have to raise interest rates down the road, and therefore the value of those bonds, just like in any other portfolio where the interest rate on a bond goes up, what happens to the price? The bond goes down. So we have been recommending shorting it's called the JGB, the 10-year bond, and it's been doing very well. Now, as of, I'm going to say, 2 or 3 months ago, we had a reversal where the index of the JGB, which had gotten down to like 137, surged to 142. And so some people were saying, oh, well, what's going to happen is that the ability to get foreign investors in those bonds, so-called the carry trade, is going to increase again, because even though the interest rates have gone up in Japan, by this time over like up to 1.5%, that's lower than they can do elsewhere. And so a lot of American or other foreign investors will be buying those bonds because they get a lot of money that they can then use to invest at higher interest rates, called the so-called carry trade. Not something I'm a great expert in. But, so do we think that, oh, well, the chance to make money by getting higher interest rates in Japan is over? Not at all. We think there's a long way to go. And why? Well, every year, it's some sort of a Japanese labor union structure. They come out and recommend what the increase in wages should be. And this year, because inflation has started to move up finally in Japan, they recommended that the average wage earner in Japan, in terms of yen, should get a 5% raise. Well, if you have a 5% raise and the interest rate on the bonds are like 1.5%, and in fact the overall inflation in Japan also is much higher than 1.5%, in the 3 to 4% range, then it's not going to last forever, even for the Japanese investor who I think famously are more supportive in general of what the government wants than just about any other country. And in this case, of course, the government wants their investors to keep buying bonds that have 1.5% interest rate when the inflation means they're losing money every year if the inflation is 3 or 4%. And that, I think, is going to continue to happen. So we think that the current index of those bonds, as I said, it's back down below 140 after being to 142, but can go way down. Now, I believe that index, if the Japanese bonds got to a 6% rate, which they have been back in the early days, that index would go all the way down from 139 to a full 100. And so this would be a spectacular source of potential investment. We recommend that people look at that and consider shorting the JGB for a considerable time into the future.